Today we're going to be learning about buy side and sell side liquidity. Thank you for watching Cashflow Marco TV. Today we're going to be learning about buy side and sell side liquidity. If you find any value from this video, be sure to like, share, and subscribe. Hit that notification bell. Shall we begin? Alright, to start, I have a diagram of buy side and sell side liquidity. But first, let's study how liquidity affects price action. Let me grab a seat. Now, price seeks liquidity when market makers and institutions push price towards liquidity pools to trigger orders and fill their own positions. Stop hunts and liquidity grabs are when price reaches a liquidity pool. It often briefly spikes beyond a key high or low, tapping retail traders before reversing. Market structure shifts or after liquidity is taken, and price may reverse sharply or continue trading depending on institutional intent and order flow, order blocks, and continuations. If liquidity is absorbed, smart money may use this area to confirm entries before the next major price move. I want to circle order blocks and continuations because that's what I specialize in, and that's what we're going to highlight today. The key takeaway: liquidity pools help traders anticipate what price is likely to move next, as institutions manipulate price towards these zones before executing major market moves. Let me stand back up. Here's an example of sell side liquidity. Here we see price reaches sell side liquidity. It doesn't come back to this order block, and it tests this price 2 to 3 times before falling below. And it only falls usually a short distance before returning back to this liquidity zone and making a steep drop to the downside. This is where us market makers would like to sell. So if it falls below, stop losses from long traders and sell stops are ordered from breakout traders. That means we will set a stop loss here in this area and a take profit down here in this area. When I say below and above, that means below swing lows. Below means stop losses from long traders and sell stops ordered from breakout traders. Above swing highs, meaning above stop losses from short traders and buy stops ordered from breakout traders. So let me show you an example of a buy position and then we'll move on. I seen price touch here once. This second time it break through, I will be looking for a long position, meaning I will make my stops around here at this level, and I will make my take profit area around this level based on liquidity. These liquidity zones are where institutions manipulate the market and fake retail traders out of their position. I know that was a lot to take in. Shall we continue? Where to enter and exit using liquidity principles. Our entry strategies will be at liquidity grabs, at order blocks, which we're going to highlight today, at imbalances, which I do have an example for, or what we call fair value gaps, or at breaker blocks. For our exit strategies, they will be at target opposing liquidity pools, at institutional take profit zones, and before a major liquidity pool grab. And here are our key takeaways. We like to enter after liquidity is grabbed and price confirms a reversal. We will also like to exit where liquidity is likely to be taken next. We use confluences such as order blocks, imbalances, and market structure shifts to refine entries and exits. Now, let's jump on the laptop and let me show you some live examples and a live trade where I used liquidity. Shall we? Here we have my trading journal from 2024, July, which actually makes a year now. And I'm going to show you two trades. The first one I'm going to show you is a order block that I used to discover buy side liquidity, but I pulled out and I did profit on the trade. But if I did not pull out of that trade, I would have took a loss. So it was basically a risk-free trade. Then I'm going to show you a fair value gap trade. Now I already have it pulled up, so follow my cursor here. Here I have an order block. This order block became valid once I had 2 touches. And also this right here is a bullish engulfing. Now, once price started to dip and made a second touch in this zone, I labeled this as buy side liquidity. So with that being said, I set a 1 to 3 entry at this zone, but this was a big no-no. Why? Because this was in a smaller time frame. And also this was GJ, the Great Britain pound versus the Japanese yen, which is very volatile, especially in the London session. So thankfully I did pull out and I profited, only 50 bucks, but it was a risk-free trade. Now let's go over this fair value gap. Now this was an invisible buy side liquidity trade. So if we were to analyze this trade here in the hourly, we see here that this is a bullish engulfing, and price touched this area not twice but 3 times. So this will be considered a valid order block. Now price did get to this fair value gap, and a fair value gap I'll explain in a second, but let me get to where sell side liquidity is above this fair value gap. Sell side liquidity reached this area here and was taken immediately based on this imbalance. An imbalance is an impulsive move to the downside, meaning when we create a fair value gap, we will want price to fill this imbalance or fill this impulsive move in the future. So we are technically projecting the probability of price coming back to this area or this zone. This is why we created this fair value gap. Now, once this fair value was created, we knew if price got back to this zone after it was broken through, it would be respected. And I also use this as sell side liquidity, but invisible sell side liquidity. And with that being said, this was the outcome of this trade. Now we go into a higher time frame in the 4-hour, and we seen that once our take profit stop loss was set, we left it there, and price shot straight to the upside, continuing to fill this imbalance above this fair value gap. I also use another confirmation, which is a Fibonacci, but I'll go over Fibonacci's in another video in the future. Today we want to focus on buy side and sell side liquidity. In this trade particularly, we use fair value gaps to find where the institution we're trading it and enter. Now, hopefully I was able to give you some insight of buy side and sell side liquidity. And in this particular video, we only were biased with buy side liquidity. So I do offer coaching, which is available, the Enlighten Me Mastermind, where I will go over buy side and sell side liquidity. So if you like to see live examples of sell side liquidity, you may sign up below. Now to end, I would like to go over this particular trade. It looks like it was on July 6th, and I believe I have the same journal as this trade was written in. So let me see if I can find it very briefly. Yes, I believe this is it. So just to give you an in-depth analysis on what I was seeing and the confluences I've taken, I'm going to go over my pre-market, entry, and post-market analysis, and then I'm going to wrap it up. Okay. 1. Where do you see price action in the higher time frames? Price is creating lower highs. So as long as price is creating lower highs or higher highs, we want to seek an entry. 2, if you were to go with the trend, where? Bull. Bull meaning up, bear meaning down. 3, are there any reversal candlesticks in your zone? A bullish engulfing in the 4-hour, which we have highlighted here, which makes one confluence. 4, where are 2 or more time frames in synchronicity with the trend? The weekly and the daily. So higher time frames give us a stronger confirmation when we are trading on this market. Always. 5, do I have a confirmation? Yes. Our Fibonacci, which is inside the 50%, zone and inside our fair value gap, which is being filled. 6, did I wait for a retest? Yes. We allowed price to flirt with the fair value gap before we made entry. Now for our entry. 1, what is your risk to reward ratio? 1 to 3. 2, which session did you enter? London. 3, how much did you plan to earn? We risked $1,200 and our reward was a total of $3,027, but we were aiming for $3,500. 4, what is your stop loss? Our stop loss was 1.27. And what is your take profit? Our take profit was 1.28. 6, why are you taking this trade? Price is retesting my fair value gap. 7, did you use any indicator sessions? 8, give me 3 confluences. We have an imbalance, which is an impulsive move to the downside. We have our fair value gap, and we also have an order block, which is invisible, but that will also be our confluence, our order block here, because we will also use this area as sell side liquidity, being that price flirted with this area twice before shifting to the upside. And where was our entry? 1.27553, and our lot size was 5. Post-market analysis. 1, did I follow my plan? Yes, I stick to my 3%, which is in my ABC trading rules. 2, what did I do well? I closed my entry and did not be greedy. 3, where can I improve in the future? This was a flawless trade. 4, what did I learn? Fair value gaps in higher time frames fill with time. 5, did I prepare properly? Yes, I monitored my fundamental analysis closely. 6, why did I take this trade? Price closed above original entry level. 7, what is it you are seeing? A 4-hour fair value gap being filled. And 8, where did you exit? 1.28169. All right, now today was a fun lesson on liquidity. If you got any value from this video, like, share, and subscribe. Be sure to hit that notification bell. Like I always say, I have a lot of value and a little time to share it. Peace.